Testing, 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 testing.
Yeah, we're live.
So it's off now,
It's,
right?
well, you just turn it off. Now it's on.
Okay. Good afternoon. We're going to get ready to begin in just a minute, but we wanted to remind you that there's food, there's water, and other things for you to choose from if you want to get up and get something to eat before we get started. Good afternoon, everyone. We want to welcome you here. I am Dawn Williams. I'm the Chamber Board President for the Aberdeen Area Chamber of Commerce. Before we begin, we want to start with the Pledge of Allegiance, so I can have everybody stand up, please. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. Well, once again, we want to thank you for being here. It is my pleasure and honor to be able to introduce to you President Neel Kashkari. Neel Kashkari has been President and Chief Executive Officer of the Federal Reserve Bank of Minneapolis since January 1st, 2016. In this role, he serves on the Federal Open Market Committee, bringing the 9th Federal Reserve District's perspective to monetary policy discussions in Washington, D.C. In addition to his responsibilities as a monetary policymaker, Kashkari oversees all of the bank's operations and was instrumental in establishing the Minneapolis Fed's Opportunity and Inclusive Growth Institute, whose mission is to improve the economic well-being of all Americans. Kashkari earned his bachelor's and master's degree in mechanical engineering from the University of Illinois at Urbana-Champaign. He went on to become an aerospace engineer, developing technology for NASA missions. But he eventually turned to finance and public policy, earned his MBA from the Wharton School at the University of Pennsylvania, joined Goldman Sachs in San Francisco, and served in several senior positions at the U.S. Department of the Treasury, including overseeing the Troubled Asset Relief Program, or TARP, during the financial crisis. Before joining the Minneapolis Fed, Kashkari ran for governor of California in 2014 on a platform focused on economic opportunity. Please welcome forward Mr. Kashkari.
Thank you for that wonderful introduction, and thank you all for being here and for hosting me in Aberdeen today. I really appreciate it. I'm really looking forward to having a wide-ranging conversation with you. Let me just start by telling you why I'm here. So the Federal Reserve is our nation's central bank. Our job, we were created by the US Congress in 1913. Our jobs, among other things, we regulate banks, but we also try to manage ups and downs of the US economy so that it doesn't overheat and so that we hopefully can try to avoid recessions. And one thing that's unique about our central bank is that it's spread out around the country. So when Congress created it in 1913, they said we don't want it all headquartered in Washington, D.C. We want to make sure different regions of the country are directly represented in policymaking. So they created something called the Board of Governors in Washington, D.C. You may have heard of the chairman of our Board of Governors is Jay Powell. His predecessor was Janet Yellen. Before Janet was Ben Bernanke and Alan Greenspan, 15 years ago or so. But they also created 12 independent regional Federal Reserve banks, the ninth of which is the Minneapolis Fed. And our job at the Minneapolis Fed is to represent this region, which includes Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin. So a big part of my job and my colleagues, there are 1,000, 1,200 of us that work at the Minneapolis Fed, a big part of our jobs are to go out around the region and make sure we know what's happening in the local economy. And then I go back to Washington, D.C. every 6 weeks. I live in Minneapolis, but I go back every 6 weeks where we set interest rates for the nation. And part of my job there is talking about what's happening in our regional economy here so that when we set interest rates for the nation, this district is represented. So the reason why I'm having a town hall tonight is I want to tell you why I'm here, but I very importantly want to hear from you on what's happening in the Aberdeen economy. How are things going? What's happening with workers? What's happening to wages? Are wages going up? What's happening to businesses? I want to hear from the ag sector. Ag is really important here. When I travel around, I've been in Minneapolis now for almost 4 years. Ag's been under pressure for a number of years with low prices. You add to that on top of low prices, you add tariffs, you add weather, and we've seen a lot of the ag sector under a lot of pressure for a long time. So that's something I'm also here in Aberdeen to learn from and hear from. Over the couple days that I'm here, we had a roundtable earlier this afternoon focusing on housing and the availability and the affordability of housing in the region. We just did a session with some small business owners. I'm doing some sessions focused on ag tomorrow. I'm visiting the new soybean processing plant tomorrow, which I'm excited to see. And I'm also doing a roundtable on opioids. Opioids is a challenge in a lot of communities around our region, and I want to hear how it's affecting Aberdeen. This is my fourth visit that I can remember, maybe fifth, to South Dakota. I went to Rapid City, went to Sioux Falls, went to Pierre, said it was time to get up to Aberdeen. So that's why we decided to come to Aberdeen today, because I hadn't been here before. And I'm happy to answer your questions about the Federal Reserve, the work that we do. People often have a lot of questions on the national economy. I always say to people, do me a favor and ask me your toughest question, because if you ask me your toughest question, it'll give me a chance to answer it. I'd much rather have a chance to answer it than have you go off not knowing what the answer is, and maybe somebody else has the same question you do. So please don't be shy. So I'll start by just saying, let me just talk for a moment about monetary policy, which is a big part of my job, and then let's just open it up to you. And we've got roving mics. We'll ask you to just wait for the microphone. Just so you know, this is being live streamed on the internet. So, just don't be surprised. Someone may see you asking me a question. There's nothing wrong with that. I don't want you to be shy. I do want you to fire away, because I'll learn more that way. So just a moment on monetary policy. I've been at the Federal Reserve for 3.5 years. Since I've been there, I've been pretty consistently arguing against raising interest rates. The reason I've been saying let's not raise rates is we talk about something. Congress gave us two goals as it relates to monetary policy. We call it our dual mandate. One goal is stable prices, and that means an economy that's not overheating, an economy that's not limping along, kind of steady growth. And then second, maximum employment. As many Americans as possible who want to work are able to find jobs. And usually we think these two things are linked through wages. So as the economy heats up, businesses have to compete with each other to find workers. They have to offer higher raises, and then eventually have to pass those higher wages onto their customers in terms of higher prices. So a tight labor market eventually leads to high inflation. At least that's what we think is supposed to happen. Well, for the last several years, we keep getting surprised how many more workers it turns out are out there. Nationally, the unemployment rate, the official unemployment rate is around 3.7%, which is roughly a 50-year low. You would think that means everybody who wants to work has a job. Well, surprising us, every month, more and more Americans are coming off the sidelines. They're not included in that number because that number only counts people who are actively looking for work. So a lot of people gave up after the Great Recession. They just said, I can't find a job, I'm giving up. So they weren't counted. And so we didn't know how much of the shadow labor force was still out there that might be able to be drawn back in. The good news is a lot of people have been drawn back into the labor force, and wage growth is now slowly ticking up, but it's not yet to high levels. And so the question we have is, how many more workers are actually out there who might be available to work if the economy keeps getting stronger and if wages pick up? So that's why I've been arguing against interest rate increases. And nonetheless, we have raised rates a bunch of times. And I'm continuing just to counsel, let's look at the data, let's look at the inflation data, let's look at the wage data. And until we see wages pick up, then we know we're not really at full capacity of the US economy. And we can talk more about that if folks have questions about that. So that's my stump speech, for lack of a better word. I would love to open it up and just start the conversation. How are things going in Aberdeen? How's the economy? What are the challenges you're facing? I hope we're going to spend some time talking about the ag sector, because ag is really important to this region. And a lot of the ag sector in my Federal Reserve District has been under pressure for a long time. And I want to hear how people are doing. So anybody brave enough to go first? Or I can call on you. This gentleman has a bandage on his hand, so it looks like his hand is up. All right, yes, sir. We got a mic coming over to you from Melissa.
You've been a proponent of leaving rates stable. How do you feel about the current talk of lowering rates this month?
So I said, you're right, I've been opposed to the increases, and then we raised them a bunch, and I finally said, well, let's just not raise them anymore, but we can hold tight. I actually, after the last meeting, came out publicly and said that I had called for a 50 basis point rate reduction. And the reason I did that was because it's pretty technical, but a big component of what determines the future of inflation and prices are all of our expectations. So if we all, as individual consumers or as individual workers, believe that prices are going to be climbing in the future, we're going to go to our bosses and we're going to say, hey, I need a raise because I know prices are going up and I need to keep putting food on the table for my family. Or alternatively, if we all believe no, prices are stable, then we don't go demanding those price increases and we're all content kind of more or less with what we're getting. So it turns out inflation expectations, all of our collective beliefs on the future, are really important in what actually happens in the future. This is the crazy thing about economics, is it's part psychology, part math psychology, part physics. Maybe more math psychology than physics. So our estimates of long-run inflation expectations are that they're a little bit too low. And so my view is if we want to re-anchor inflation expectations at the level we want them at, 2%, we need to do something that kind of shocks the system to says, no, the Federal Reserve is really serious about achieving our inflation target. So my argument is, I don't think a one cut, 25 basis point cut by itself is going to do very much to re-anchor inflation expectations. I think we need a little bit more of a stronger punch. And that's why I advocated for a 50 basis point cut. And again, it's technical. I also said we should commit to not raising rates from that new level until we actually see inflation get back to our target, as a way of further signaling that we're really serious about this. So I'll give you an example. This is Japan has had low inflation for a long time and low interest rates, zero, for a long time. And by any measure, their job market is super tight. A lot of Japanese are working, and yet they're not seeing fast wage growth and they're not seeing high inflation. One of the theories for why is that the Japanese people are now so used to low inflation that it's just become embedded in the psychology of the country, and it's hard to break out of that funk. We certainly don't want that to happen here. And so that's why I was arguing, let's give it a little stronger medicine to boost these expectations back up so we don't head down the path of Japan. Great first question. Sorry it was a long technical answer, but it's an important question. Other questions?
So in your introduction, it was brought up that you were instrumental in TARP, which was about a decade ago. Looking back 10 years later, would you say it was as important as it was sold to us as, and was it a successful program all in all?
Sure. So from 2006 to 2009, I was at the U.S. Treasury Department, and one of my jobs there was working on the financial crisis when the big banks were collapsing. So I was in charge of the TARP program, the Troubled Asset Relief Program, which was the $700 billion program, you might remember, that Congress passed to stabilize the banking system. I would say that we hated that we had to do it. You know, I was part of the Bush administration. We were a free market Republican administration. We believed if banks made bad loans, they should eat their own lunch. But if all the big banks had been allowed to fail, instead of the Great Recession, we could have been facing the Great Depression. And so that's why ultimately the Bush administration went forward and the Obama administration continued to ask for Congress for this authority to stabilize the banking sector. So I believe it was absolutely the right thing to do. It was like, sending in the fire department to put out a fire. You got to do it because the fire is raging, but then you never want to ever do it again. And you want to make sure that everything is safe enough so it cannot happen again. So when I joined the Minneapolis Fed, we started a major initiative to look at the banking reforms that have been done, to ask the question, have we now solved the problem so this can't happen again? And our conclusion was no, we have not solved the problem. The biggest banks in America are still too big to fail. In fact, they're bigger than they were before. They have more capital. So if you take out a loan to buy a house, my wife and I bought a house when we moved to Minnesota. Our bank made us put 20% down on our home loan. The more money we put down in our home loan, the safer it is for the bank because there's more of a buffer so the bank can get paid back. That's why they made us put 20% down. Well, the big banks in America today effectively put about half that amount down on their own portfolio of assets, their own borrowing. So the big banks are much tougher on us than we are on the big banks. And in fact, small banks in America have a lot more capital than the biggest banks, which is the reverse of the way it should be, because the small banks are not risky for the US economy, the big banks are. So long answer, TARP was absolutely necessary in my opinion. It worked, it prevented the banking system from collapsing. That's good, but we never ever want to do that again. And the best way to protect us from ever having to do that again is making sure the biggest banks have enough of their own skin in the game so they can cover their own mistakes and they don't have to turn to taxpayers. Thanks for your question. Yes, sir.
With the CFPB, which is an acronym just like everything else that comes out, but Consumer Finance Protection Bureau, has that been a benefit to you? Has that been a disadvantage to you? Are we better off today than we were before?
Well, I don't think it's necessarily an advantage or disadvantage to the Federal Reserve. The CFPB's mission is about protecting consumers. And I'll just confess, I don't know enough details on the day-to-day operations. I'm sure every time there's a new agency created, I'm sure there are some issues and kinks that need to be worked out anytime. There certainly were when we created the TARP from scratch. But I do think that they are an advocate for consumers, and that consumers do have somebody they can call and say, hey, this bank or this credit union or this other financial, this auto loan company is not treating me fairly. I do think the idea of having somebody who says, hey, I'm going to look at this and speak up on your behalf, I think that's a good thing. But I can't tell you beyond that, do they have the dial set appropriately? Are they taking it too far? I don't know. I'm wondering, though, because you asked the question, if you have an opinion. Sorry, I'm going to turn this around. I mean, this is how, otherwise I'm just answering questions. I want to learn. So what do you think?
In answer to the question, I would say that they overreach a little bit, but I'm a firm advocate of the consumer because I am a consumer, and I think it's important that we take care of the consumers because that's really what our country is run on. But they might have had a little bit of overreach and they might have went too far, but I can see some real positives from it. But I know in banking, the idea is to make it so that we don't have problems in the future, and I haven't seen any major closings, but I have seen some big exposure as far as dollars and cents, and I'd name the banks, but they might be in the room.
Okay. Other questions or comments? So let's talk about the ag economy and how it's affecting Aberdeen. What I learned today is that Aberdeen is very very dependent on ag, but Aberdeen does have more diversification than some of the smaller communities around. But it's still very ag-centric, and with commodity prices low and weather, it's been a challenging period. What's the outlook? I mean, how's it next couple of years? I hear from farmers that say, we don't know how long we can hold out, that we've had low prices for a long time, and they're hanging in, but it can't go on forever. But at the same time, we haven't seen land prices fall very much, which one might expect. If the ag sector is really under pressure, you could expect to see farm prices fall, and we haven't really seen that. So just curious, anybody want to take a bite at that? Really? Farmers don't talk. How about this gentleman's got his hand up?
Yeah, Chris Pearson, CEO of AgTegra Cooperative. We serve about 7,500 farmers south of North Dakota. I think as you think about our economy, it is pretty tough right now. So we have a lending portfolio, as the banks in the room do. Our estimate is that 2/3 to 3/4 of the working capital on farmers' balance sheets from the good years, in many cases, has eroded to this point. I think that's pretty consistent with what we've heard other places. And right now, we just don't see a great path forward. So a lot of times you can say, well, if this changes, we're good. And I think even if the China thing is fixed, which seems to be the biggest thing we talk about, there still seems to be some real demand destruction that's happened there. And we're about the furthest source of grain right here in the United States from any market, right? So, and our primary market is export to the West Coast. And so even if we get China fixed, will their demand for soybeans, especially from the West Coast, be what it was before? And I don't think it will. And I think it takes a while. So pretty concerning. And then we're probably, from talking to my peers around the United States, we're probably the third most challenged area, I would guess, from a prevent plant production standpoint this year. And so as you think about probably, if we've got 20% prevent plant and 18% yield drag on the balance of the acres, that's somewhere between 35 and 40% production impact on our farmers, right? Which is a huge deal. And I think that creates some uncertainty as well. So crop insurance is there. Generally, farmers kind of know where they might settle out there, but then there's the next round of money from the Trump administration, and there's just uncertainty around that. So when we're uncertain as an industry, what do? We don't spend money.
Yeah.
And labor is certainly tight, but in tight times, how do you raise wages? So the only way we have to combat that is to have fewer people if we're going to raise wages. So we'll be very challenged in our business financially this year. That's just the way it is. We're a reflection of our farmer owners. And so it will be a tough year.
Thanks for speaking up. Other comments? Microphone's coming to you.
I'm not very good at words, so I'm just going to kind of say how it is. I'm a farmer's wife. What do you see the future of farming and the tariffs and stuff? Because we can't even go to the bank necessarily and get money to sustain us to the next. And crop insurance doesn't always pay. I mean, it just covers enough, maybe.
Well, I wish I was good at, I could tell you where commodity prices are going or crop prices are going. I don't know. You all are probably much more expert than I am, though we have some experts at the Minneapolis Fed who pay a lot of attention to this. It strikes me that U.S. farmers continue setting new production levels. I mean, record, very productive farmers. And if you have a lot of very productive farmers, unfortunately, that often leads to lower prices. And then you layer on top of that the tariffs, which adds a lot of uncertainty. And then you layer on top of that weather, and weather is what weather is. It's good years and bad years, and different ways of being bad years. Too dry. Right. No. Yeah. No, I understand. So I wish I had better news to tell you, or say it's turn the corner and it'll all be better. But I don't. I just don't. I can't say that. I wish I could. And you're seeing parallels with in the banking sector. A lot of community banks are going away just because it's harder with all the regulations. It's hard for community banks to be standalone, so they're being absorbed into larger banks, which is also, in some sense, hollowing out rural communities because it's much harder for a big national bank to service that rural community than it is for the local bank. I think you're also seeing that in the ag sector. Small farmers, small family-owned farms are selling to bigger, more financial farms, more farms which have more financial resources that can withstand the low prices for longer. And I don't know what's going to change that trend. It seems like that's continuing. So I appreciate you speaking up, but I don't have a better answer. Yes, sir.
Could we, or could you address, earlier you were with the small group, you talked a little bit about your theory on workers related to wages. Can you expound on that for the larger group and share that with us?
Sure. So, one of the puzzles we've had is as the unemployment rate has fallen, why haven't wages picked up more? And I said part of my explanation is there's this shadow labor force of a bunch of people who are actually interested in working. They're just not answering the surveys. And it's remarkable. If you look at the way the data is collected, so the US government collects this data every month and publishes it, a lot of people will answer the phone and they'll say, I don't have a job, and I'm not looking for a job. I'm not in the labor force. And then those same people are called the next month and they've taken a job. But the last month they just said they weren't even looking for a job. How does that work? So we don't know how many more folks are out there like that might actually take a job. So that's part of it. What is the shadow labor force? How many people are out there? Another part of it is, businesses love to tell me, businesses and farmers, oh my gosh, we have a historic worker shortage. There are no more workers out there. And I say, okay, are you raising your wages? No. I said, well, if you want more of something, typically you need to pay more for it. And there's something very emotional about wages and workers and businesses. So if the price of corn goes up, and corn's an input to your business, or the price of steel goes up, or the price of oil goes up, businesses shrug their shoulders and say, yeah, the market price went up, I got to pay it. But if I can't find workers at wages I'm used to paying, it's a historic worker shortage. I don't know why the reaction is so different when it comes to workers than it is any other input into your business. And so what I'll always say is, well, look at North Dakota in the oil boom. North Dakota had 2% unemployment, wages went through the roof, and they sucked in workers from all around the country. If you pay more, they will come. Now, obviously, that doesn't work for the whole country at the same time, because if everybody around the country tries that, you only have so many people. But that ultimately that'll show up in inflation. And then we would know, hey, the US economy is now at capacity, time to tap the brakes. But in my opinion, until we see wage growth pick up, that means we're not really at full capacity for the US economy. The US economy is not overheating, so there's no need to tap the brakes. And anyway, when I say this to businesses and I say, if you're not paying more, then you're just whining, they get offended. But somebody's got to say it. Other questions? Sir.
So you're talking about wage growth. There's been a lot of discussion recently and several articles recently in the Wall Street Journal about a $15 federal minimum wage. What sort of impact do you think an artificial increase in the base wage rate would have on the economy?
Well, I think, and so the city of Minneapolis, by the way, and the city of St. Paul have passed ordinances to raise the minimum wage to $15 an hour over a number of years. And we at the Minneapolis Fed have committed to do a long-term economic study on what's the effect of that. So some studies have said if you raise the minimum wage, it's really good for workers because their wages go up, obviously. Other studies have said, but their hours go down. And so it may be that their take-home pay doesn't actually go up by very much if businesses end up just cutting the hours. Some studies have said, yeah, those people who keep their jobs take home a lot more money, but some people lose their jobs. And so you've got winners and losers. In fact, the Congressional Budget Office just put out a study this week looking at the impact of raising the minimum wage. And it said there are trade-offs. Some people who keep their jobs are clearly better off, but some jobs are destroyed. As a general rule, I would say raising the minimum wage, my personal opinion, is better done at a regional or local level because South Dakota is different from San Francisco, is different from New York City, is different from Texas. And it's probably better for I would think it's probably better for each of those regions to be able to determine what's the right level for that region. That's one principle. Second principle I would say is there are going to be fewer trade-offs, fewer people are going to be hurt if you're doing it at a time when the economy is strong and unemployment is low. So if unemployment was at 10% and you raise the minimum wage, there'd probably be a lot of people who are hurt by that. But if unemployment is 3% and you raise the minimum wage, I think there'll be relatively fewer people who end up being hurt by that. So I think all things being equal, this is probably a pretty good time to do it if you're going to raise the minimum wage because unemployment nationally is pretty low. But I think it's a complicated topic. And by the way, that's why I'm such a proponent of just making sure the labor market's as strong as possible, because if you have a strong job market and businesses have to compete with each other for workers and wages are going up across the board, there are no losers. They're all winning. All workers are winning in that scenario, and more people are getting jobs. So that's the Goldilocks scenario where you don't have to have these trade-offs.
I'd like to follow up on my previous question, I guess. And when you talk about the shadow labor market, so I run the local economic development entity here, and whenever we're talking with either an existing business about expanding or new businesses coming into our market, the first thing that everybody always refers to is, you know, do you have any workers? So specifically on your shadow labor market people, do you have any ideas on how we could get them to come out of the shadows? Because that would make my job a lot easier.
Well, I would push back when people say that to you. I'll give you an example. A lot of businesses you hear anecdotally, let's say, move to Austin, Texas. I've heard of many tech companies moving to Austin, Texas. It's lower taxes than California, a very educated workforce. Nobody says, you know what, I'm going to move to Detroit because there are a lot of laid off people in Detroit. Businesses want to move to where there's a vibrant economy, and generally when there's a vibrant economy, by and large, people are all working. So I've never heard of somebody saying, I could move to Austin, I can move my business to Austin or Detroit, but I'm going to pick Detroit because there are a lot of laid off people there. It's just, I've never once heard that. So this notion of, well, do you have workers available? I think it's the opposite. Are your people working? If people are working, they've got skills, they're gainfully employed, I'm going to go compete to attract those workers to my business. I just think the idea that you're going to move a company somewhere because there are a bunch of laid off people, I can't think of a single example where that's ever happened.
Welcome to Aberdeen. Thank you for coming to our community.
Thank you.
Aberdeen and the region has been an area that has worked very hard together to grow its economy and opportunities, as you've just discussed. And over those years, the Federal Reserve Bank system has provided a lot of support in terms of initiatives or research about how to grow your community. A lot of community development, economic development, research or initiatives taken by the feds. Any recent or current work in that arena that this group might be interested in?
Sure. Well, one of the things we launched a couple years ago, this thing called the Opportunity and Inclusive Growth Institute, which is focusing on disparities in economic opportunity. And we know in America there are racial disparities, but there are also urban and rural disparities. And we want to see how can we have an economy that's growing where everybody gets to participate and everybody gets to benefit from that. I don't have an answer. That's a long-term research study where we don't necessarily think that monetary policy, we can't target it to Aberdeen. We can't set one interest rate for Aberdeen and a different interest rate for San Francisco because we all use the dollar, one currency for all of us, so it's one interest rate for the whole country. But if we can use our research to illuminate fiscal policy programs that your legislature could take up as an example, then we want to do that. We feel like we have a contribution to make from a research perspective. One thing that I've seen as I've traveled around our region is the communities that are, the smaller communities that are having more success are making their business climate locally as attractive to entrepreneurship and business as possible. You have higher education here, which is a huge advantage compared to the communities that do not have universities or colleges. So that's a big source of bringing talent into your community and spurring new ideas and new innovation. So that's a source of strength. Very strong partnerships between the business community and the civic leadership and working very closely together on a strategic plan to try to make this region competitive. And then lastly, I've seen some communities in our region really embrace immigration as a way to really boost economic growth. If you look at where does economic growth come from, it comes from productivity growth, which is inventing new things and better education, and it comes from population growth. More workers to produce things, more consumers to buy things. Well, the fact of the matter is we're having fewer kids than prior generations did. So we will have slower economic growth just by the math of the fact that we're having fewer kids. Well, what can we do? You can either accept slower growth, you can try to subsidize fertility, literally, tax credits to families to have more kids. By the way, it takes 20 years to grow a new worker, so that's a long-term strategy, if it's even possible. Or you can embrace immigration. And this has been a big competitive edge for the United States relative to other nations. And so I've seen some communities, I think it was Sioux Falls that when I visited there, I was amazed at Sioux Falls population growth driven by a very focused strategy around immigration. And it really seems like it's really worked very, very well. So some communities have done it very well, and they have real strong economic growth. They have schools that are vibrant. Other communities where they're losing their young people, the schools are shutting down, their populations are just shrinking. And so I think it's that partnership between business and the civic leadership. I think it's the university system, a good business climate, and then immigration. Those are the elements that I've seen successfully put together to really drive economic growth. Whether, what sector you should focus on is not for me to say. I mentioned at a prior meeting, a lot of cities around America say, I want to become the next Silicon Valley, right? That's a very hard thing to do. The cities that are more successful are playing to their strengths. So this is an ag economy at its base. If there are sister industries, brother and sister industries that come off of ag, that will probably play to your strengths rather than just saying, hey, we're going to be the next cell phone center, something where you may not already have a competitive edge. Long answer to your question, but good question. Thank you. So how about, let's talk about I'll come to this gentleman in just 1 second. I'm interested, I'll come to you after I ask my question. I'm really interested in the labor market. What's going on? What's going on in wages in Aberdeen? Are employees jumping from one firm to another? I'd just like to get a sense of the vibrancy of the job market here. What are businesses seeing and what are workers seeing? So maybe you could think about that, but we'll let this gentleman ask his question first or make his comment.
I'm particularly interested in the issue of immigration. I do have what influence on the economy it does have, and I do have relatives who have immigrated to the United States from Southern Africa, some who are involved in the egg industry here in the Aberdeen area. But a couple of things. My partner is a foreign citizen, and basically we've been working on this 4 years. He's here now, but now waiting for his green card. So that's really frustrating when you have people who want to work, but because of the government bureaucracy, it takes years and thousands of dollars to get them a legal work visa. And then it's also frustrating for me when I see all the stuff in the news that people walk across the border, and in places like California, they're talking about giving them free health care. When people who work hard to do things the legal way see all these people doing it illegally and reaping all the benefits. And so that's kind of frustrating. And I don't know if you have any comments on that, but this definitely affects the economy when people want to do the legal way and they can't, and people who do it illegally and get rewarded.
Yeah, I understand. I mean, to say for me, it's personal. My parents are immigrants from India. They came here 50 years ago for education and then got jobs, and they went through a legal path. My wife is an immigrant from the Philippines. She's been here 12 or 13 years, and now is finally, she got her visa, and then she eventually got her green card, and now she's in a position to apply for her citizenship, so she's going through that process. So you're right, the legal process takes a long time. My own personal opinion is somehow we have to design a legal system that works for our economy, because it's a competitive edge for America that people do want to come here. And while we're not perfect at integrating everybody, we're better than anybody else in the world at it. We're literally better than anybody else in the world. And so to me, we should design a system that feeds our economy, but then make everybody use the legal system as the mechanism to come in. So I think I'm sympathetic with what you're saying. Now, the politics of that are, very, very difficult, much above my pay grade. But somehow we got to do it. We'd be crazy not to. Other countries, it's a big advantage for us. I want us to compete in the global marketplace, and having a legal immigration system that meets the needs of our economy seems like a great way to do that, my opinion. So can we talk about the labor market and what's happening in Aberdeen? Wages, workers, are you seeing people? Some cities I go to, manufacturers will say, oh my gosh, the workers are just jumping back and forth, one company to another company to another company, because they're just getting raises. And so employers are feeling a lot of pressure. I'm just curious, what's the dynamic here?
I can start because I spend a lot of time doing that, visiting with specifically manufacturers. I think you see two things, Neel. You see if the manufacturing company takes care of their workers, and it's more than just wages. Yes, it requires a good wage, but if they do the small little things, you don't see the jumping from that particular manufacturer. However, some other manufacturers need to probably hone in on taking care of their workers maybe a little bit better. Those organizations tend to trade back and forth. And lots of times you do see, hey, manufacturer A is paying $16. Next week, manufacturing B is going to pay 17, but then manufacturer A figures out they got outfoxed by $1, so the next month they're up to 18. And you do see certain people bounce back and forth, multiple times in a really short span. So it certainly happens.
What about in the ag sector? So the woman in the back talked about the farm being under a lot of water, so you can't plant. What about the workers who would have been working there? I'm just curious, and I don't mean to pick on you, it could be anybody. Where are they now? Like, what are they doing now if they're not able to work on the farm that they had expected to work on? We can bring the microphone to you if you have.
They just come to job service.
What is that?
The local Department of Labor, looking for other jobs.
I see. So they land somewhere else.
They try to, yeah.
Other thoughts? This gentleman over here. Thank you. Just so folks on the screen can hear you.
Neel Whitcroft, Wells Fargo Bank. I'm the Ag Senior Regional Credit Officer. And one of the things that we see is that the smaller farming operations with the lower commodity prices just simply can't generate enough cash flow to service any amount of debt, really, but also to provide a sustainable living for the family members. And so they don't have the capital to grow. The commodity prices are not cooperating. And so they're going to have to go out and find alternative work. And so I think there's ag producers out there that had traditionally not worked off the farm that are looking and working off the farm. So that's part of it.
I see.
But the other thing is that we see a lot of these younger ag producers that have gone through college and come back to the farm when things were great, $8 corn and so on, make a lot of money. They've learned that that's not reality. But we're seeing them to be very innovative. They're figuring out ways to stay on the farm but generate another source of income through maybe being an advisor. Maybe they have a commodity experience and they're doing getting paid to do blogs or whatever. So we're seeing that kind of thing. But it's really it's really the smaller farmers that are really in a jam in this current economy. You had mentioned land prices not coming down, and commodity prices started to decline in 2014. So we're in the fifth year of that, yep. And so you wonder why land prices aren't coming down if revenues come down so much. Well, part of it is that there is a tremendous amount of equity in the land because the land prices have inflated substantially over the last umpteen years. And so there's a lot of lenders willing to restructure the debt, and rather than calling it restructure, we call it rebalance the balance sheet, and give them the liquidity they need to continue to operate. Some ag producers are now going into the third round of that, so that equity is starting to dry up. And so it'll be interesting to see how long that can go. The other thing is there's a number of us that were raised on the farm, related to the farm, maybe the next generation to be the owners of the farmland. And we're investing in that land. It's not generating a great return, maybe 2 or 3%, 2.5%, 3% really, if you're renting it out. But there's a lot of people that have that vested interest in the farm. They're going to retain that land value. And so that's another thing that's keeping land values where they're at. So, as it relates to employment, though, I do think that there is individuals that are seeking work today that they weren't seeking before because they were fully employed on the farm.
Yeah.
And I guess my question to you is, the employment rate, is that non-farm employment?
Yeah, I mean, there's many different measures of non-farm payrolls is a common one that we look at. We look at a lot of different measures to try to get a sense of what's happening in the U.S. economy as a whole. And there are seasonal adjustments. There's adjustments for different sectors, like, as you said, farms, for government, for private sectors, private payrolls. And we look at all of these different measures to try to get a picture of what's happening in the labor force. Probably the cleanest measure that we have, that I look at, is the percentage of Americans who are working. Do you have a job or not? Then you're not asking somebody's opinion on, do you want a job? Do you consider yourself in the labor force? Just, are you working or not? And we know that our society is aging, and as people retire, you're going to have fewer Americans working. So we also look at something called prime age employment to population ratio. So 25 to 54-year-olds, that's the prime age is what they call it. And we're still below, we're roughly where we were around 2007 in terms of a percentage, but we're still below where we were around 2000. And there's no good explanation for why a smaller percentage of working age adults should be working today versus 20 years ago. There's no good reason. And we're lower than many other industrial countries. Again, no very good reason. Some people point to drugs, opioids as an example. Some people point to a lot of incarceration, so people with criminal backgrounds who then can't get a job, disability, a number of different things. But as this job market has gotten stronger, we're actually seeing, it used to be that the view was once somebody considered themselves disabled, then they were gone from the labor market forever. They just kind of gave up and found other ways of getting by. Maybe they got disability insurance. But as the job market has gotten stronger, we're actually seeing people who used to say, I'm disabled, who now have jobs. I mean, that's great news. That is great news for the country. It's great news for them. It's great news for the country if we can put more and more people back to work, because then they become contributors to society, which is good news. So we don't know how many more are out there. This gentleman has a question.
Yeah, just speaking for our business, we've had about three.
What is your business?
Agriculture, ag cooperative.
Okay,
so,
yeah, that's right. Thanks.
We had about 3.5% wage growth year over year from last year to this year. But as I mentioned before, with the economic environment where it is, if we give any raises, it'll be because we're able to invest in technology and reduce jobs. That's just the nature of it. I think the other challenge we have right now is we offer a pension, and the PBGC pension benefit guarantee corp, we're paying about 8 times the premium we should be there, which is worth about $1 million just to our business that should be going into wages, and it's not. So we've been working through Congress and trying to fix that. We haven't made any headway yet. And I think to your previous point, we've never seen a time where we've had more trouble getting people through drug tests, pre-employment drug tests, and into the workforce. So there's one thing about people being available. There's another one about whether they're hindered in one way, shape, or form of being able to enter the workforce. And that the opioid thing is real in our business.
Yeah. And I'll say one thing, and this is not going to work for many businesses. Certainly, if you're going to be driving a implement, some tractor or something, but some businesses are saying, "Hey, we don't need to we're just not going to do the drug test anymore." And for certain categories of jobs, that is okay. But obviously, for some categories of jobs, that's not okay. If you've got to drive something, as an example, so we're seeing that. We're also seeing some firms saying we don't need to do the criminal background check for these certain categories of jobs anymore. So you're seeing people with blemish records who are coming back into the workforce. And we're also seeing people lowering minimum qualifications. So it used to be some jobs said, we require a bachelor's degree. Now they say, you know what? An associate's degree is just fine. Or a high school diploma is just fine. And then they'll say, we'll train you. Because I'll say to a lot of businesses, I say, we can't find somebody trained in how to use this machine. And I'll say, okay, well, why don't you find somebody able-bodied and train them yourself? And now you're seeing businesses do that because they have to. And again, my perspective is that's great news. People are getting trained. Businesses are investing in workers. They're ultimately getting productive people. It's not as easy as they'd like it to be, but it's ultimately good news. So that's why we need to keep the economy going. Other questions or comments?
We have time for about 2 more questions, so don't everybody rush to get them in now.
This gentleman up in the back, and then the gentleman up here in the front. I think did you have your hand up?
Yeah, is there something that the feds can do about the exchange rate that can help the farmers?
Good question. Sadly, the answer is no. So the Fed does have the exchange rate policy, dollar policy, is considered to be the domain of the U.S. Treasury Department and ultimately the executive branch. So when Congress created the Federal Reserve, they gave the Federal Reserve certain authorities and certain tools, and they said certain things are hands off. So monetary policy is our domain. We set interest rates to try to manage the ups and downs of the economy, but we don't do fiscal policy, as an example. Fiscal policy, that means how much you're taxed, how much I'm taxed, and what our tax dollars are spent on. That's fiscal policy, that's Congress's job. Exchange rate policy is the U.S. Treasury's job. Now, I will say, we know that monetary policy can have an effect on the dollar. Generally, if we're raising interest rates, you would expect to see the dollar to go up because foreigners will want to invest in America to take advantage of a higher return environment, which will mean the dollar will go up. So we at the Fed don't target the dollar, but we do pay attention to these feedback loops, because if we raise interest rates, that causes the dollar to go up. That might change how the global economy is competing, and then that may have effects back on the US. So we try to model out what these feedback loops are, but we're not actually targeting the dollar per se. We're trying to achieve our dual mandate of stable prices and maximum employment. So complicated answer to your question. Short answer is no, we can't target the dollar, but we do pay attention to it, and we know what we do has some effects on it. Last question to the gentleman in the front.
How do you foresee us being able to respond to AI and automation taking jobs away from people who would be willing to work those jobs, but it's more economically viable to have the automated system do that?
So I'm a big doubter of the hype of AI. You know, when I was in engineering school, AI was allegedly around the corner. You know, there's a joke that cold fusion has been 20 years away for the past 50 years. That's true for artificial intelligence too. For very narrow classes of problems, like little puzzles, artificial intelligence is very good. But any kind of generalized intelligent system, it's right now a fantasy. And so if you look at allegedly there's all this AI taking place, but we've got very low productivity growth. If there was actually all this artificial intelligence taking place, you would imagine there's very high productivity growth, but we're actually seeing low productivity growth. So like self-driving cars and trucks is an example. Are they going to come? I think they're probably close enough that, yeah, in the next 10 or 20 years, we'll probably having self-driving cars and trucks on the road. But allegedly, all these trucking companies say, we can't find truck drivers. So my guess is, even if artificial intelligence did come along and long-haul truck got replaced with AI trucks, you'd probably have truck drivers doing the local deliveries, or the nature of the jobs are going to change. So, I mean, the nature of a market economy is one of change. People said that when automation was brought to farms 100 some years ago, workers are all going to be displaced. What's going to happen? Well, farm employment went way down. Farmers got wildly more productive, and workers ended up moving to cities and moving into factories. So I think my view is the nature of the work will continue to change. It's always been changing. But the idea that this is the end of labor and the robots are going to take over. I don't know, do you ever watch Terminator? The original Terminator? So Skynet, the computer system, was supposed to go self-aware in 1997. That's when, in 1983, they predicted artificial intelligence, the brain turning on in 1997. Here we are in 2019, we're no closer to that happening. So I'm not a buyer of the doom and gloom scenarios that Silicon Valley is putting out there. So sorry, I went on a little bit of a speech. In any case, let me just say thank you for your time. Thanks for coming here today. Thanks for asking your questions and offering me your insights. So far, it's been a great trip to Aberdeen, and I look forward to learning more tomorrow and hopefully coming back again. So thanks very much. Have a good night.